The Bank of England has slowly raised interest rates, which is killing buy-to-let investors. In this video, I'm going to break down how much money a buy-to-let investor would have made before the interest rate rises, how much they're making today, and what's a much better alternative. Now, the UK interest rate started going up from January of 2022, which you can see from this green line. So it used to be around the 0.5%. And it's just been going up all the way to currently 4.5%. Now, the properties I was buying before 2022, I could pretty much comfortably get a mortgage of 3.5% interest rates on my buy-to-let mortgages. So let's say 2021, you buy an investment property for £320,000. Now, you can buy something which is more expensive or less expensive. I'm just using one of my properties as an example. If you put down a 20% deposit, that comes to £64,000. The next thing you have to pay is stamp duty, which is a tax you pay when you buy a property. So to work that out, go to stampduty.org.uk, scroll down, select additional property, assuming you already have a property that you live in and you're looking to buy this as an investment. So £320,000, calculate. The stamp duty comes to £13,100. Next, you have some legal costs, so let's put that as £2,000. And then let's say you furnish the property and that costs around £5,000. The total investment, i.e. how much cash or how much money you've had to put down yourself, is essentially all of these costs here. So the 20% deposit, stamp, legals, and furniture. So that comes to £84,100. Now let's work out how much cash flow this would make you before the rates went up. The rent on a property like this would be around £1,750. To work out the mortgage, you can just Google a mortgage calculator. The one I use is this one here by Money Saving Expert. You have to put down your mortgage debt, which basically means the size of the loan. So if you're buying a property for £320,000 and you've only put down 20% yourself, that means 80%, the remaining balance, is your mortgage, which in this case would be £320,000 multiplied by 0.8. So that's £256,000. So 256,000. Now, when you're buying a buy-to-let property, you would typically have an interest-only mortgage, not repayment. So you check interest only. The typical rate I was getting before all of this happened was around 3.5%. So 3.5%, scroll down and click calculate. So that means your monthly mortgage payments were £747 per month. Now, for maintenance, I normally account for 10% of the rent just in case something goes wrong, something breaks. And this property also has a service charge, and that's something you have to pay when you buy a flat as opposed to a house. That for this property is £100. How much money you make on a monthly basis is £728 per month. If you take an annual cash flow, which is, well, how much you make per year, which is the monthly cash flow multiplied by 12, which is £8,736. Now, if you want to work out the return on investment, which basically just means how much money you're making relative to how much money you've invested. So in this case, you're making £8,736, but you had to invest £84,100. That means your return on investment is 10.4%, which is, pretty good. Now, this is what happens to the cash flow once the interest rates go up. So a few months ago, I mortgaged one of my properties and I didn't get a rate of 3.5%. I ended up getting a rate of 5.3%, which is significantly higher because rates have gone up. So if we do exactly the same exercise, and this time we keep everything the same and change this to 5.3% and click calculate. That means the mortgage payments are now £1,131. This mortgage has gone from £747 to £1,131. As a result of that, if you do exactly the same thing again, the monthly cash flow now is not £728. That has gone down to £344. That means the annual cash flow has gone down to £4,128. If you were to work out the return on investment, now you're making £4,128, but your investment is still £84,000. So that means your return on investment now is 4.9%, which is essentially half of how much you were making before. So just by interest rates going up from 3.5% to 5.3%, which is less than 2%, the amount of money you're making as a return has literally halved.
By the way, just like interest rates are a potential threat to your property business, this is the biggest threat to your business overall. This is called the man-in-the-middle attack. Now, I spend a lot of time working from coffee shops, and in coffee shops you need Wi-Fi. So when you click on the Wi-Fi's, you see all these different options. I normally just go for the one which doesn't have a password so I can access the Wi-Fi. What I didn't realize was that these networks could literally just be fake networks, and the second you click into it, a hacker can gain access to your computer, and if you have any sensitive information like passwords, bank account details, passports, they can now access all of that information. Now, to make sure that doesn't happen, all you have to do is sign up to NordVPN, who's also the sponsor for this video, and download their Chrome extension. Once you have the Chrome extension downloaded, click on the extension and click Quick Connect. Once NordVPN is connected to your computer, that will make sure you're protected by any online threats. If there's any malicious links, any dangerous website, NordVPN will warn you And on top of that, whenever you download a file, it will scan that file to make sure there's no viruses and it's not a hacker who's just trying to access your computer and access all your sensitive information. By now, you can get an exclusive deal from NordVPN by clicking the link in the description below, and it's completely risk-free as you get a 30-day money-back guarantee and eliminate any online dangers to your business.
And so that is why a lot of buy-to-let investors are leaving the market, and they're saying it's not worth it anymore because they're investing so much money only to make a 4.9% return. So therefore, if this model no longer works because the rates are so high, well, what's a better alternative? This is essentially what I'm doing instead. Now, rather than buying a nice property which is in good condition and then renting that property out like people would do in this situation here, you need to buy a property in terrible condition which you can add value to, like this 1-bedroom flat I bought in Battersea Park. Now, this is the floor plan. You come through here, you have a kitchen which was in pretty terrible condition. The bathroom was also equally as bad. You had a bedroom and you had a living room. Now, I essentially took this kitchen and I moved it into the living room, and I made that into an open plan living room, and the existing kitchen, I turned that into a second bedroom. As a result of that, the value of the property has gone up because it's gone from a 1-bedroom into a 2-bedroom, but also because it's now in much better condition compared to what it was before. And this is why that helps you make a lot more money. So I bought this 1-bedroom flat for $237,150. The stamp duty, which is the tax you pay when you buy a property, was £9,357. The refurb to modernize it and also turn into a 2-bedroom cost $29,700. The legals came to £3,267. The finance, I bought this property on bridging finance, which basically means imagine a mortgage, but not for 25 years, but for 12 months, but you have to pay a lot more money. That came to £8,806. I furnished the property, which came to £5,000. So therefore, the total cost came to £293,280. Now, I didn't put that much money up as cash because I had a mortgage, but this is just to keep the numbers simple. So my total cost was £293,000. Now, once the property was converted into a 2-bedroom property, it was then revalued by another bank at £320,000. Now, at that stage, I went to the second bank and I refinanced the property, which basically just means I got a new mortgage on that property. So they valued it at $320,000 and they gave me an 80% loan, which meant I got a loan of £256,000. Now, if you think about what's happened here, I have spent £293,000 in terms of buying this and turning this into a 2-bedroom. Once I've done that, the bank has given me £256,000 back. So therefore, this property has only cost me the difference between this and this, which is essentially this area here. And that comes to 293 minus 256, 37,280 if you want exact numbers. Why that's important you'll see in a second when it comes to the cash flow. So if we look at the cash flow again, based on the fact that the interest rates have now gone up, the rent is 1,750. The mortgage now is £1,131. Your monthly cash flow is 344. The annual cash flow is 4128. The big difference now is this. If you were to invest in buy-to-let properties the normal way, which no longer works, you're making £4,128. But in order to make that, you have to invest £84,000, which as a result made you a 4.9% return. But what's happening now is, by doing it this way, if you look at the return on investment now, you're still making £4,128. But the big difference is, it didn't cost you £84,000. It only cost you £37,280. So therefore, your return on investment is now 11%, which is more than double how much money you would make buying buy-to-let properties the normal way. Not only that, you end up with a property worth £320,000 for only £37,000, as opposed to for £84,000. So not only you're making more money, you've got back most of your investment, and you can then use that money to essentially buy the next property, get some money back, buy the next property, get some money back. And that is a much better alternative to simply just buying buy-to-let properties and renting them out.